Meeting will come to order. We have to have a roll call first. Susan?
Captain Lohr,
Here.
Milt Wilkins,
Here.
Mike Bruno,
Here.
Brian Hansen,
Here.
Jim Cunane, and Emily Koenig.
Here.
Okay.
Okay, first order of business is approval of the minutes of the December 30th meeting. Everyone's had an opportunity to review the minutes. Are there any suggestions for modification? There being none, I'd like to ask for a motion to approve the minutes of the December 30th meeting.
Motion to approve, Mike.
This is Brian. I'll second.
Okay, moved and seconded. All those in favor say aye.
Aye. Aye.
Anyone opposed? None opposed. Move on. Okay, then we have the approval of the benefits. As usual, we'll take retirement benefits first. We have 19 civilian requests unless something else has come in, Denise, that I did not see. 19
It was
civilian.
19.
Okay, fine. Thank you. 19 civilian requests. Are there any comments concerning the requests? May I have a motion to approve?
So moved. Moved. Second.
Okay, Jim moved and Brian seconded. All those in favor say aye.
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 Okay, anybody opposed? All right, we also have 4 police requests for retirement benefits. Any comments on those requests? Okay, may I have a motion to approve then?
So moved, Mike.
Brian, I'll
Would like to
second.
Brian will second again. All those in favor, say aye.
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 Any opposed? Please so indicate. Okay, we'll move over to the death benefits. Thankfully, there is only 1 civilian request and no police request. May I have a motion to approve the 1 civilian request?
So moved.
May I have a
Second again.
Okay, moved and seconded. All those in favor say aye. Aye.
Aye.
Any opposed? Okay, there's no reason for action on the police requests since there are none. We really have a very full agenda today, and it's pretty much an ACG agenda. But we will have a closed session at the end of the meeting before we hear visitors to discuss a legal matter that's come to our attention. Okay, Jason and Phineas, I'd like to hand it over to you. Could you take it in the order that you have planned?
Sure. Thanks, Milt. I guess first off, could we be allowed to share documents?
Yeah, Jerry, will you let them share their screen, please?
Who is that needs to share screen?
Jason.
Jason, okay.
So I'll just start off. Thank you, Milt, and good morning, everyone. We do have a few items to cover this morning. No action items, but I'll go over a brief review of the performance portfolio for the year ending 12/31, some comments on the markets, and then we are going every year we update our capital market assumptions, both our intermediate and our long-term assumptions, and we revisit your asset allocation just to really inform the board as to what realistic expectations are, confirm your level of comfort with your existing asset allocation, long-term asset allocation. And then finally, we were asked to bring back some information that we had previously reviewed at several meetings earlier in the year on the private equity investments and fees. So with that, just starting off with some comments on the market. As I mentioned, as you'll see, calendar year returns were very strong. We finished off the year with a positive December as equity markets rose with concerns about the Omicron variant starting dissipating a bit in the month of December. Although lingering concerns that we've been talking about for some time related to inflation and Fed policy, really starting to see the impact of that this month as equity markets really across the board down anywhere from 5 to 10%, really looking for a bottom as concerns about inflation and what the Fed's going to do. We've seen the 10-year move up as high as 1.9. As of yesterday, the 10-year was at about 1.187. And I say that if we think about a year ago, 10-year treasuries, kind of a proxy for core bonds, was below 1. And so we've moved up quite a bit. But if we put that in more historical perspective, we're still, despite a 100 basis point move in the 10-year up, we're still well below long-term historical averages for yield on bonds. And so the returns that we've experienced the last 3 years have really been fueled by easy monetary policy. And I think, as we'll see, our forward-looking assumptions are much more muted as we're not too indifferent from what we talked about last year, as we're starting from low yields and higher valuations. That said, when Finney will talk about our capital market assumptions, they have changed a little bit from last year, particularly the intermediate. They've actually gone up slightly, and that's because yields, the fixed income yields are up, and inflation is up, which is a factor in the building blocks we use for equity and real estate. But if we back out inflation, real returns expectations are about the same. So just looking at your overall allocation at the end of the year, or total value of the portfolio, closing in on $1 billion, although January we backed off that a bit. You ended the year with $966 million. Total fund performance, you'll see the 1-year column for the total fund net of fees right in the middle of the page there, up 15.5% relative to the strategic policy index, which is how your assets are actually allocated, specifically relative to those relevant indexes. You outperform that by about 1.8%. And then a broad policy index, which is just global stocks and bonds, you've outperformed by about 1.6%. Another question always comes up, is this final? Does this include real estate? It does include real estate numbers. As you'll see at the bottom here, real estate had very strong performance in 2021. Your overall real estate composite was up 24% in the calendar year 2021, outperforming the Odyssey by about 3%. Really, on a 1-year basis, the major asset classes perform either in line or ahead of benchmarks. Your large cap equity slightly behind, about 1%. And this 2020, we saw your large cap really outperform. 2021, a little bit more challenging, particularly on the growth side. Jensen a little bit more conservatively positioned. Once again, in calendar year 2020, we saw a handful of names really dominate performance in the S&P 500.
Jason, can I ask a quick question there?
Sure.
Just because you're getting right at the topic I wanted to ask you about, and if you're covering it later, we can save it for that. But given the significant run up in the S&P and that was driven by, a handful of stocks, are we comfortable? And I know we had increased our allocation to passive within the large cap space a few years back. Are we comfortable with the high level of concentration within that index into 5-10 names, or is that something we should be thinking about in terms of diversification?
Yeah, Brian, we continue to be comfortable with how the large cap portfolio is intended to be implemented, which is roughly 60% passive, which we changed a few years ago. You were 100% active. And we acknowledge that it is, particularly within US large cap, over time, it is much more challenging to outperform net of fees. And in recognition of that, we moved from 100% active to 60% passive and 40% active with complementary growth and value managers. And really, as we look at performance, it's actually gotten better despite the 1 year trailing by about 1.4%, still up 24%. I'm sorry, 20 trailing by 95 basis points, the large cap composite. The longer term now has gotten better. When we made that change, your large cap composite was slightly behind the S&P 500 when you were more active. And now through the end of calendar year 2021, the 10-year net of fee return is about 28 basis points ahead. All that being said, I think we have enough active component at 40% with the complementary managers to navigate the choppiness in markets that we're potentially going to go through. It's going to be more of a stock pickers market, at least in the near term.
And that's what I was thinking. I mean, I'm more thinking about downside risk, and I know there's a desire to save on fees and be passive, but I'm just concerned, given the high level of concentration within that index, that
we're saying the 40% active, instead of going 100%.
Okay.
So I don't think there's a need to change. Your small to mid cap composite, very strong performance on a 1 year basis, outperforming the benchmark by a little under 6%. That's the combination of Earnest and Granite. Granite had a very good year. Within small cap, a little bit different story. Large cap, really, we didn't see that huge rotation into value. Growth and value components of large cap were essentially the same in 2021. Within small cap, there was a huge dispersion between growth and value, with the small cap growth slightly positive, up about 2.8%, and value, small cap value, up 28%. Your small cap manager, the combination of the two, Granite, more of a core manager with a bit of a growth bias, smaller cap focus, did very well, up 16.7%. And then Earnest, more of a relative value, they'll move into some mid, it's a SMID strategy, did well, trailed the benchmark a little bit, but still up 25.5%. So having some of that larger exposure in the small to mid did benefit there. So really relative to the small cap index, strong performance. The non-US equity, this is a roll-up of all your non-US equity managers. So the developed market managers, WCM and Sanderson, as well as your developed market small cap, Mondrian and William Blair, and emerging markets. Pretty significant outperformance there. A lot of this driven by a couple of managers in the year. WCM, very strong year. And then Acadian. And Acadian certainly worth mentioning. Probably at this meeting last year, the January meeting, we were talking a lot about your emerging market allocation. You had two managers, LSV and Acadian. Looking at it at the time, a decidedly value bias. We felt we could still get broad emerging market exposure with a single manager to smaller allocation. It's overall target of a little over 6%, 6.75%. We eliminated LSV and just kept Acadian. Acadian outperformed the benchmark by over 11% in the year. The emerging market benchmark was down 2.5%, and Acadian was up 8.5%. So really benefiting from that decision that was made really this time last year.
And just maybe add an anecdote to that, Brian, to your question about concentration. If you remember, we brought both our emerging markets managers in last year. They talked a lot about the same phenomenon, right? What we saw in the U.S., we saw in emerging markets with concentration of the index at particularly the the tech sector and those names taking up such a big chunk. And so again, to your point of the downside, we saw that fall off in emerging markets kind of since then over the last several months. And so having some of that active risk, more diversification in their stock picker ability, be kind of an example of kind of how we're thinking about that, and certainly the risks there that are in the markets.
Fixed income, over a period the last year, rates have risen by about 100 basis points. You're not immune to that with IRM and Western having interest rate sensitivity. Really important part of those strategies is to provide principal protection and income in more challenging environments. As yields tick up and you have a little bit better opportunity there. They were really able to navigate the earlier part of the year by having credit outperforming in the first half of the year. It's about 15 basis points behind the benchmark for the year, but certainly in line with expectations.
Excuse me, Jason, could you advance the pages here because we're still looking at the cover page?
Oh, I was just talking to those, but we can, if we want to look at them, can. So IRM, you'll see there actually outperformed by 4 basis points the ag, and Western about 33 basis points behind the ag. Western is more of a core plus. We'll have a little bit more credit. They have some more mortgage-backed securities than the benchmark, slightly behind. But longer term, you'll see that's what's been additive, where you're getting from Western on a 3 and 5 year basis over 100 basis points of excess return. We'll go into the deeper dive on individual managers at the February meeting. I was trying to hit the composites, but if there's any specific questions, happy to address them. And then finally, with real estate, the roll up of your 3 real estate managers up 24%. You'll see that 1 month, which is the 1 month in the quarter, is the same because you get quarterly marks on your real estate portfolio. So we're reflecting it being hit in December, but it's all for the final quarter of the year. The third quarter of 2021 was the best performing quarter for the Odyssey Index, the core open-end real estate index in the U.S. since like 1978, only to be beaten by the fourth quarter of this year, where we see the index up almost 7.7%. You see your 3 managers all up north of 20% ahead of the benchmark. And really, I'd say a bit surprising coming off of what we maybe expectations at the early stages of the pandemic and how things seem to be changing with brick and mortar. The areas that really benefited, certainly industrials and warehouses up, close to 50% on the year, and then multifamily doing very well. And office has actually held up fairly well over the last year. Not really seeing the impact there.
Is there any international exposure in the 3 real estate funds that we participate in?
Very little, Brian. I mean, these are all the domestic funds.
Okay, that's what I was thinking.
So very little. You will see though that with this performance, we had been underweight to real estate. You had about 5 or 6% underweight to real estate, and now this has ticked up through the strong performance. I expect, when we look at January numbers, we're going to be a little bit over target, just because equities have fallen a bit in the month, depending on where we end up in the next week. But you did put some money to work. PRISA 3, they call down capital. They made several capital calls during the year, and we put a little bit more money to work in your other real estate managers during the year to get that up to target. So now you're essentially at targets. So overall, again, very strong performance. I'd say that the end of the year, just on a snapshot basis, with 3-year returns now annualized for the total fund at over 17.5% net of fees. Your 10-year return annualized at over 10% net of fees, very strong 10 years. And again, we'll talk about asset allocation. You've benefited from this, but looking backward, the last 10 years are not indicative of what we would expect the next 5 to 10 years. Certainly, it's being thoughtful and how we decisions are made going forward.
Jason, this is Mike. Can you hear me okay?
Yes.
I've got in front of me one of these charts that ranks the asset classes for the last 10 years, 10 different asset classes. And for 2021, REITs was the #1 asset class with a return of 40.5%. And I'm just wondering what that seems like such a huge difference in what we did with our private real estate. Any comment on that?
Sure. Public REITs have a high correlation to equities. Your equity managers own public REITs. Our philosophy is that in an institutional portfolio, having private real estate over the long term, you'll get similar returns with a lot less volatility. For the month of January, the public REIT index is down over 10%. So it's tracking public equities.
Yeah, Mike, I would just add that public REITs can trade at premiums or discounts to kind of their net asset value. And if you think of December 31 of last year, REITs were significantly trading at large tunts to net asset value. So just a return to kind of normalcy, kind of turbocharged REITs performance last year.
Okay,
so we have some education that we can do, Mike, and maybe if we show these charts just to kind of support our position and our philosophy, if we want to talk about that in the future.
Yeah, listen, what you say, I understand, makes some sense. Although I do look at what they do is they give the annual returns each year so REITs in 21 were the #1 performing asset class. In 2020, they were the worst performing asset class. So I hear what you're saying. At the end of the 10-year period, the average return of the REITs was the 4th best asset class, were 11.5%, which I think is a full percentage point more than what we've done in the private equity. I think you said we're doing like 10 something over the last 10 years.
Well, I don't have 10-year composite data.
The 10-year number on here says 9.44. So that's about right.
The
REITs did 11.5 for 10 years.
Yeah, that's the index. But REIF did 10.4. Yeah, the difference from a Sharpe ratio standpoint, you're going to get a much higher Sharpe ratio, a lot less volatility with private REITs. So from an asset allocation and diversification standpoint, our feeling is private REITs are a more attractive way to build.
Well, and let's face it, you're paying a lot more money.
Well, these are all net. These are net of fee returns.
Right.
We'll look at that and provide you some more detailed analysis on that.
Well, I think it's probably a good idea, just, kind of as doing our fiduciary duty, just to kind of go back through it again and make sure the private REITs makes more sense than the public ones. I would vote for public REITs, but, I'd like to see some more data on that. That'd be great.
And I do want to continue to point out, you do have public REIT exposure through your equity managers. Your U.S. and non-U.S. equity managers own public REITs. They're part of the index. They're part of the Russell 1000, Russell 2000, and the EFI. The managers own them.
Yeah, I understand that too. Although I don't think in some of the indexes, REITs are part of it. I don't think.
Well, they're not a big part of it, but the value of this is they're certainly relevant.
Okay. Anyway, I saw that number and I saw that 10-year, and think it'd be good to go back and kind of look at them both.
And Mike, the only thing I'd add on the 10-year number is we're a little bit further away from the financial crisis, but again, I think public REITs probably bounced back. I remember there was a 10-year number that showed public REITs dramatically outperformed, but the start date was like March of, it was probably first quarter of 19 or 20 or something like that. So the beginning point, if they're significantly under net asset value and they just come back to normal or trade at a premium to net asset value, that's really, I think, the difference in because at the end of the day, the public REITs and the private real estate funds are investing in the same assets. The volatility of the asset is no different. It's just how often you measure it. You're measuring the private real estate funds quarterly. You're measuring the value of the public real estate funds daily, and based on what the market thinks. So it's not just an appraisal process, which I think is what adds to that volatility number. But at the end of the day, they own the same assets. In fact,
well, what we're all doing now is guessing why the public REITs have done better than the private. What we ought to do probably is, I would assume data's available, and I have no idea what it is, but go back another 5 years and go back another 10 years. I mean, we're in a portfolio that has an infinite time horizon. We ought to be in the best asset in each asset class. And if where we are is right, then great. Let's just, when I look at the 10-year numbers, I'm not convinced.
Well, you're just looking at turn. I mean, and I understand Brian's point about volatility and how it's marked, but it does matter on a month-to-month basis when you're marking assets from a funding standpoint or valuation standpoint. Private real estate is just less volatile. It's not going to have the same, and it doesn't, the price appreciation or depreciation doesn't correlate to the equity market. So that when equity, if you're making a measurement for actuarial purposes on a specific date and equities are down 20%, having real assets that aren't correlated to that for whatever reason, if it's appraisal purposes, can be a benefit. And so we'll just, I think when we look at that, we're included.
So in 2020, when the market had a great year, large caps up 18%, REITs are down almost 5%. So they're not following the market.
Right, but your private real estate was not down 5%.
No, but the argument that Brian's giving is that, and you are, that the returns flow in some instances or partially from the way the market's doing. And in 2020, it's exactly the opposite.
Right. Again, it's not flowing the way the market's flowing, but it's flowing the way the market is perceiving real estate. And at the end of 2020, people were still concerned whether or not people were going to be shopping in malls or whether people were even going to be coming, back into offices. There's still some of that overhang over those sectors of real estate now. But I think if you look at the individual sectors within public real estate, you'll probably find a dramatic dispersion. Data centers and cell towers did really well. Industrial did really well. Apartments were okay. Office and retail were crushed during the pandemic.
Yeah. So the markets are up 40%.
Revisit the real estate allocation and how it's implemented and provide education on that.
Yeah, let's.
The allocation
Right now, I wish we were in the public REITs over the last 10 years. We'd have made a whole bunch more money. So let's go back and.
By the way, in the Russell 1000 core, real estate is 3.45%. Of course, there are REITs, which are actual real estate, where it's really landowners, so to speak. And then there are other REITs, which are operating REITs, like hotels and so on and so forth. I don't know how that's categorized in Morningstar. But according to Morningstar, real estate itself is in the Russell 1000, about 3.5%.
Yeah, I'm not surprised.
Right, let's move on.
We're going to change gears and just review the asset allocation. If that, I can.
Yeah, and this is something obviously, every year we update our capital market assumption. Of course, we look at it on a longer term basis. We actually look at it in a couple different lenses from a time frame standpoint, from a 10-year perspective, as well as an even longer term 30-year perspective. Of course, as I think Mike just mentioned, we're, forever institution, so even longer than, those long time periods we really value. And some of the driving forces from last year, overall, the story really isn't changing, as Jason mentioned early on. Some of the big aspects, whether it's equity market valuations, certainly, as we all know, we've experienced this great run of returns in the public markets over the last several years. Kind of hard to continue with that. Also, where we are based on from the fixed income standpoint. While rates are up about 100 basis points from where they were a year ago, they're still relatively on relatively low relative to their historical standards. So ultimately, we continue to think that over the last 10 years, we had double-digit returns. I think over the last 5 years, we're up 15% or so. Probably not realistic to expect going forward, but certainly we think we're kind of still in the right asset allocation mix for what we're looking to over the long term. And so you can go to the next page. So first off, on the valuation standpoint, and again, just why we think this is so important to look at. This is a graph, and we've kind of showed you every year, but basically what we.
Go ahead.
Sorry, Mel, do you have a question?
No, go right ahead.
I'm sorry. So what we plotted here, and this data goes back to the mid 1970s. But basically, what we look at is, at the certain endpoint, what is the PE valuation? How expensive the S&P is at any one time measured by PE, and then kind of going north and south is then what was the return 10 years later on that. And so you can certainly see there certainly is a pretty big correlation there, that the more expensive, the further you are to the right, the higher the PE valuation, the lower the return is over the next 10 years. Similarly on the fixed income standpoint, we continue to see, and we're certainly not alone, I think the industry would say this too, the best predictor for returns from your bond portfolio is currently what you're yielding. And so again, that is what we're mapping here. This looks at our benchmark, the Barclays Ag, what it's yielding at any one point, and then what its return is over the next 10 years. And again, it's kind of, you can see where we are in that purple dot. As Jason mentioned, we continue to be on the lower side of historic, and so certainly that's not helping us from a return standpoint. That said, year over year from last year, rates have gone up about 100 basis points. That's helpful. And then the other impact that we'll see as you flip to the next page, well, actually one more, is on inflation. And so again, one thing that we're certainly, as we all know, we're seeing more and more, predicting more to happen over the next several years is inflation really run through the economy, and that certainly flows through and runs through our investment portfolios. And you can kind of see inflation, while of course we have an average, it's a little under 3% over the last 100 years. It's actually even higher than that the last 50 years. It's almost 4%. Certainly, we all know we've experienced significantly less of that in the recent, really 20, 30 years. But so actually, as we're coming off this really low from an inflation standpoint, we actually think we're going to start seeing more of that. It's hard to predict year over year, but as we look over the next 10 years, over the next 30 years, we do think that is going to continue to pick up. And so actually, if you flip to the next page, as we look at our assumptions, kind of building blocks here of where we think, where we expect return to be, both, again, kind of an intermediate term is there in the middle. That's what we predict over the next 10 years. And then further to rise over the next 30 years. The first thing I would point out is what's on the left-hand column. This is the return, particularly the equity market indices over the last 10 years as of 12/31. They continue to be, particularly in the U.S., but really almost across the board, higher than their long-term averages. So again, we very much benefited from that as investors in our portfolio, but realistically, we don't expect that to go forward. So you can see kind of where we think from really an equity standpoint, we continue to think there are higher avenues for potential returns are in the areas that we have in our portfolio. You see private equity, which we're going to talk about again a little bit more. We've talked about a lot in 2021 about ways to allocate to private equity, because again, we continue to think there would be high returns within international emerging markets and even developed markets, again, that haven't had the great run there as we have experienced in the US. And then what I do want to point back up, just again, at the very top, inflation in this middle column, this 10-year. For the most part, well, I should say a year ago, our expectation for inflation over the next 10 years was about 1.7%. And so you can see that's gone up about 70 basis points, really in line. We're not making it up. That's what the market is telling us when we look at the various indices out there. And so again, that's a strong building block in our component. And so you can see basically in the intermediate term, particularly from an equity standpoint, you see our numbers on an absolute term actually peak up a little bit, somewhere between 0.5% to 70 basis points, actually for emerging markets, because of valuation a little bit more to actually, which we think helps on the go forward expectation standpoints. Apologize, I'm trying to flip the screen and having some technical difficulties here. And so, ultimately, this looks very similar to what we discussed last year. So what we have here is, our policy allocation there on the left-hand column up front, what's in our investment policy statement as our asset allocation. On the far right, the ASAP target. As you all know, private equity has been in our portfolio, been in our target for several years now. We're just starting to implement. And so from the ASAP target, what the only difference there is it's a blank for private equity, and that's including the public equity markets. And then the current in the middle is actually just our actual asset allocation, which is very close and very similar to our ASAP target. And so just to point out a couple things here as we look down into this first section. So these are our expected returns over the next 10-year period. And so that first row right there, this is our asset allocation using last year's assumptions. So if we were to come together with our assumptions from last year, we would say our policy target, we'd expect about 5.5%, 5.43 over the next 10 years. You can see as you look down that column, it's the same asset allocation with this year's assumptions. So at a 6.2%. And again, really it's kind of the drivers of actually why it goes up. Some people might wonder, well, markets went up last year. Why are these going up? Well, in particular, it's really certainly rates on the fixed income side, helping out a little bit, but also particularly inflation. So from a nominal perspective, it actually helps out from an expected return standpoint. And as you look across the three of these, again, first you can see all of them continue to be under our current hurdle rate, right? We continue to think returns, relatively lower environment, given the great run we've had really over the last decade plus. But as you look in between the difference of them, certainly from a more attractive standpoint, and this is both on a volatility standpoint, but even more importantly, as we were just talking about from a return standpoint, is the policy on the left-hand side. And again, that difference being private equity. We continue to think private markets are still able to drive some of this superior returns, particularly above public markets as we move forward.
And just, asking, is our policy target right? With the private equity and the targets we have to the various asset classes relative to the ASAP target, that's just the target of the portfolio for allocating that 6.25% to private equity, pro rata to the other equity components, and keeping everything else static. The current, again, that has drift in it because your portfolio just drifts over time. But if you look at the Sharpe ratio, the highest Sharpe ratio is the policy target, which means that's the most efficient portfolio relative to these others. And over time, over the long time horizon, the median return is 7.75. Again, just important to put that in perspective. That's a 50. We run a Monte Carlo simulation based on our capital market assumptions. It's not just return, it's standard deviation and correlation. And then this is the output. So over a long-term time horizon, your policy target with private equity has a higher median return, meaning there's a 50% probability that it'll be 7.7% or higher, 50% probability to be 7.7% or less. But the risk or standard deviation is 11.6. With private equity, that's lower than the ASAP target without private equity. And then certainly better than where we've drifted to. That first percentile return, just so everyone understands that is intended to be like a worst case scenario in any 1 year. That's not next year or over that time horizon. That's any given year. That each one of those mixes has a 1% probability of being down that amount. And you'll see that the policy target is actually a little bit, it's better by a couple percent, the worst case probability. I think we'd all be concerned if we're down 20% or 20 versus 22 or 24, but that's just mathematically what that works out to. And that's actually probably pretty comparable to what we saw in 2008. That was about a 1% probability at the depth of the trough of the market.
And so, yeah, again, I think, looking at that longer term, again, while in the near term, we have maybe our realistic goggles on. You look longer term, we still, think our allocation is well positioned to certainly, hand us that hurdle rate we need, as our expectations. And you can see here on this page, and this just breaks down by the different percentiles. So as Jason was mentioning, that 50th percentile right in the middle that we've graded, and this is over the various time periods for our asset allocation. We also do the 25th, 75th percentile, 1st and 99th. But again, you look at that 50th percentile and look at our policy. Yes, over the 10 years, you think, okay, maybe it's tough. But you look over the 20 years and then certainly the 30 years. Again, us being this long-term institution, we continue to think our asset allocation is in a strong position to hit us the return that we're being asked to deliver. I want to so we did want to flip forward. We're trying to flip forward just to give some perspective. I was going to go to the next one.
Not sure why we're so sluggish here. Sorry. Oops.
So just to give some perspective, it's always nice, to, I guess, to know what others in similar position to us are doing. So we actually have two different data points. This first one is from NASRA, National Association of Retirement Administrators. And this looks at return assumptions going back several years and kind of what they were up until where they are now. And it's somewhat of a hard graph to read, but it's actually, if you follow the color coding, a little bit easier. So the way to look at it, if you go back, and that's 2001 there on the left, 01, that big chunk in the middle is, and this is percent of plans that have been surveyed, who had a return assumption, and that blue is 8%. And so what you can see is certainly 8% was the bulk of public plans across the country in 2001, but certainly also as you kind of ranked it, that's where the median fell. If you were to rank them by highest return assumption to lowest. And then you can see if you follow that same blue bar up and to the right, you can see there's only about 1% or so who have 8% still. And we're actually currently, if you look at 2022, you can see where that median is right now. And that's actually, you follow that all the way down to the left, and that's at about 7%. So again, kind of maybe 20 years ago, that started at 1%. That's crept up now, and that's in the median, and that between 7 and 7.5 are the two biggest contributors. And then we also have, just as far as a survey from NCPERS on actual discount rates of public plans who participated in this. And what you can see, and it's plotted really kind of across the board in terms of assumptions. But basically, the average assumed rate of return for all the funds responding was basically that 7.25%.
This was the most recent survey by NCPERS, the National Conference for Public Employee Plans, which was in 2000. It was based on 2020 fiscal year data. We haven't seen the 2021, but I don't anticipate it's going to go up much. So that's just perspective, because I know while you look at the return expectations from our capital market assumptions, and you could look at some other advisors where they're coming out at, just understanding where your peers are as well. The market has just come down and people are recognizing that.
By the way, Jason, the 7.26% was for what period of time? Intermediate or long, 30-year long term or what?
Well, it's the return assumption that public plans are utilizing for their assumed rate of return, their actuarial assumed rate of return. So,
Yeah, so we don't know if this is based on 20, 25, or 30, and some mix thereof. It's not on a standard or apples to apples
and you don't
basis.
define that in your actuarial assumptions. It's long term.
Right, so like ours is 7.25, and then
No, that's fine. I was just interested. It's probably over the long term in any of them.
Yes.
Because these are public plans. It would probably take more than a 10-year perspective. But I was just trying to understand if there was any data on that.
But comparing them to our capital markets assumption, if you defined it as if you defined long term as 10 years, your capital markets assumptions would say would be somewhere between 596 and 620.
I don't want to confuse things, Brian. This is not a capital market assumption. This compared to what you're using for your assumed rate of return.
Yep.
For your actuarial valuation is now 7.25. So
no. I'm just saying, based going up to your page, I think 9. You're giving us what, based on your capital markets assumptions, what you think the returns for our portfolio would be in, the policy, the current, and the ASAP target. And so if you look at 10 years, we think over the next 10 years, we'll get somewhere, call it 6 to 6.25. But over the over the 30-year period, you would expect those portfolios to yield somewhere between 755 and 774. So depending on what you define as long term, when we think about our assumption for coming up with that 7.25 that we decided on last year, if 7.25 based on these assumptions, we're probably not likely to get that over the next 10 years, but over 30 years we should outperform that.
We're exactly right. And so just to be clear on the page 9 you're looking at, Brian, so it would be between 794 and 808. So the box you're looking would be.
Oh yeah, sorry, I was looking at the box above. Yep, got it.
It's the same exact point. Likely over the next 10 years, we think we might be short of that, given how great the run we've had over the recent time. Again, our last 10-year return is up over 10%. But over a 30-year period, we think that would correct again. The pendulum will swing back and actually have an annualized, or call it around 8%.
And it's just, you got to get through the short term to get to the long term, and
Yep.
you've got to fund things along the way. So I guess, the bottom line is, I don't think we wouldn't suggest you go up, but where you are today with your assumed rate of return is reasonable based on our intermediate and long-term assumptions as we go out further in time. And it's reasonable compared to what peers are doing.
Go back to that page, please, that Brian was referring to. Is that page 9 or page 10?
Page 9.
So this page just has a little bit more data, and this is showing over time. So the way the model works, the intermediate assumptions are used exclusively in the first 10-year period. And then as we get out over longer time frame beyond 10 years, it's blending the intermediate and the long-term assumptions. And that's why you see on a 20-year horizon, you're somewhere in between where we are projecting the median to be at 10 years and 30 years.
Go back to page 9, please. Okay, where do you have your expected returns by asset class?
It's up a page.
Yeah, there we go. Page 8. Thank you.
just, the model is not as simple as multiplying the weight times the assumed rate of return.
Yeah, no, it's simulation. It's a Monte Carlo thing. Okay, thank you.
So the last thing we had, we're just asked to revisit some of the information that we provided, I think in April, May, and June regarding private equity fund fees and what the expected fees are on the private equity investments that we're making. If I can,
Yeah, I think, part of this, well, I think if you remember last one, a little bit issue sharing screen. So now, even though I guess we're having a little bit of an issue flipping through, after the second page, Jason. And so basically, again, these are a lot of pages that we've gone through earlier in the year, in particular, April, May, and June, presentations we gave to the board. If you remember, we had portfolio advisors come into the board, but certainly I think there was a request to kind of look back on the fees paid from the private equity standpoint. And so just taking a step back at the higher level for private equity, again, just a quick reminder, you look at these different boxes, and in those middle rows is the fees. And so traditional private equity fund, again, is called, there's, the typical term is 2 and 20, but it could be 1.5 to 2 is a management fee that you pay to a private equity vehicle as you invest. And then they do charge a performance fee on that. It's typically about 20%. That is after the term preferred return of 8%. So simply what that means is private equity fund has to have return after the management fee above 8%, and then they can start charging a performance fee. That's typically around 20%.
They participate in the profit, or they'll take 20% and you get 80% of the profit.
And saying a fund to fund, which portfolio advisors is, invest in these primary funds, and they themselves charge a smaller fee, but that is on top of the primary vehicles. And so there's maybe just we'll go to this page. So wanted to again send a reminder, this was pulled from the presentation that portfolio advisors gave to the board, and they certainly went through in great detail that they actually offer different options in terms of fee structures for the types of funds that we invest in, whether it's primary funds, secondaries, as you remember, is just later stage private equity funds. If a private equity vehicle takes 10 to 12 years, they get to invest or try to invest it in year 7 to 12, or co-investments, direct investments to the fund. And maybe hop 2 pages. And it's probably simpler, but this was from one of our presentations back in May to the board, where we outlined the various options to the board for again, the primary, the secondary, and the co-investments. The portfolio advisors invest in each, and what fee structure we would choose. And basically on the primary standpoint, you can go with the high management fee, no performance. You can go with the no management fee, high performance fee, or we chose in the middle, the lower management fee, the lower performance fee, again, that has a hurdle rate. They have to earn a certain return before they get that. And then in secondary and co-investments, they basically give you the option if you want to pay a fee based on committed. So again, if we're committing, just as an example, if we're committing $60 million, day one, we would pay based on the committed amount. Instead, they draw it down over several years. You can pay a slightly higher percentage, but only on what's invested at the time, which we believe will certainly save us fees and help get out of the J curve a little bit better. And so if you go to the next page, in talking with Milt earlier this week, he thought it would be helpful. Certainly this is a high level example, but if we were to kind of just say kind of all in, what would the fees be? As you can see on the left-hand side, and I'll just go left to right in terms of what this is, but this is just assumptions, broad average of the marketplace. From a primary fund, a secondary fund, or a co-invest, about what the management fee would be for each, what their carry performance fee they would charge on that. You can see then portfolio advisors has a different fee that they would charge on each of the different groups of both advisory fee and a carry. Oops, sorry, he's going right back. And then the one thing portfolio advisors allows us to customize our allocation, and that's that column E, where basically we talked with the board about going half in primary funds, traditional private equity, about a third in secondary, and 20% in co-invests. Ultimately, we think, like I said, help get money invested faster, also escape some of the J curve.
And lower fees.
And lower fees. And so there's math on the right, but it's basically a weighted average of all of this at that 50, 30, 20, which comes to around, again, broad estimation, but all in to underlying managers and to portfolio advisors, our management fee would be about 2.2%. After that is taken out, and it's the last bullet above this chart, there would be a carry between 10%. It depends on the different levels we're into. After you reach that hurdle rate, a performance fee of about 24.5.
So carry is participation in profit. It's not a fee on the amount you invested. It just means they're going to participate in 24% of the profits and you participate in the other 76. The bottom line is these results that have been delivered and the expectations, the capital market expectations, those are net of fees. We've seen private equity be able to deliver this. And the box that's highlighted here are the last three funds, the 2013, I can't see the numbers, 16 and 19, but the performance there is net IRR that Portfolio Advisors has delivered after all fees versus a public market equivalent, what you would have received had you invested your cash flows at the same time into the S&P 500 or the ACWI, and you can see that a pretty significant premium net of all fees has been delivered.
This is Mike. First of all, thank you for doing this. I'm the one that asked about the fee thing because I couldn't figure it out. But the page before you, the one you have there now, I think, which shows 2.2% annual management fee and the 24.5%, that tells me what the fee is. And that, relative to the 2 and 20, it's a little higher, 10% on the average annual fee and about over 20%. Basically, you're taking 20, they're going to take 25% of any gains we make in the portfolio. And I see that after the results look great after that's all done, but that's what's happened in the past, what's going to happen in the future. I'm not going to, I voted no for getting into private equity and we voted for it, and that's fine. I did put together last night, and I wrote this myself, so it's probably, maybe you'll find some fault with it, just a couple bullet points on what we're getting into. Number one, this investment will provide limited liquidity as opposed to what we have now. They're highly leveraged investments, which means greater risk. The holding period is generally long. The fees are multiple layers. We've seen that here. The valuation is almost impossible to value these things until you're out of them, because there's no way you're going to get an actual fixed valuation like we can on a stock or whatever. Performance, there's voluntary reporting for performance. There's survivorship bias because private equity firms go out of business too. And their performance is difficult to measure. Quality managers, you need big money to get in on the best deals. And we don't have big money in this. There's a money glut. There's so much money chasing private equity deals. It's almost impossible to get the good deals if there are any, and the good managers if there are any. Risk, a lot of private equity firms go out of business. Capital calls, there's money every year or every other year, or every 5 years, whatever, we're asked to put more money in it. And finally, our fiduciary responsibility of really knowing what we're doing. And I don't know. Anyway, that's that.
Can I ask a clarifying question on the fees? The 24.5%, that's only on returns over 8%, correct?
Yeah, this is an estimate based on what potential fees could be, but yes, it's over an 8% annualized hurdle.
Yep. Which is higher than your 10-year expected return for large cap US equities, right? So we're only paying that percentage if we're getting a return that's higher than what we're expecting to get out of the U.S. equity markets.
Correct.
So if we get a return lower, we're paying the 2.2% only. I just want to make sure that's I'm understanding.
Right. And even the 2.2%, this is hard to understand. That's on committed capital. That over time, that number lessens, and even in the underlying funds. There's a
fair point. Fair point. So it's something less than 2.2%. So I don't think the point is valid that you're certainly paying higher fees. I don't think anyone will debate that you're paying higher fees here in private equity, but that 24.5% has to be put in context of that's only if there's likely only going to be paid if there's some significant success to our benefit.
Well, when you buy a stock, you pay to buy the stock. If there's significant gains, you get it all.
Correct.
Thank you.
Yeah, no, Mike, I'm just trying to clarify how the fee structure works. And we're expecting lower returns in the future. So the performance only kicks in if we end up with what likely it kicks in. Well, if our capital assumptions are right, we'll only be paying that carry if they had some significant success over the U.S. markets. We don't know that for sure, but.
And our market assumptions are just that. They're assumptions. We don't know that.
So Mike, would it be fair to say that you believe that ACG's capital market assumption for private equity yielding 10.6% over the next 10 years and 13.2% over the next 30 years net of fees is wrong?
I have no idea. I've been in this business over 40 years. I don't predict the future, and I don't know anybody that can. Now, I understand
you vote on a discount rate that we have to use. And so I'm trying to get at how do we determine what that is if we just, I don't know. I hear what you're saying about private equity, and I'm not quite sure what to do with it.
Well, we're not going to do anything with it. We're going to get in private equity. We've already voted to do that, and
my sense is you're saying that's a bad thing. Am I misunderstanding?
My sense is, that I wish we weren't doing it. Yes, that's correct. But that's a whole nother issue. I mean, I don't want to rehash this thing. I don't think that's fair because we voted to do it. I just wanted to.
But it is germane because I think one of the things we're doing today is we've got to make a determination on the discount rate, and we're basing our determination, whether or not that discount rate is or the market return rate is reasonable based on capital markets assumptions that are being provided that I assume you disagree with.
I'll be honest with you, I didn't even pay attention to it.
Well, that's problematic.
Really?
What?
On the discount rate, we're going to do as we've done over the last 3 years. The quality of work here at ACG is really very, very fine. But I've also gone to Mercer as well as Morgan Stanley, because I sit on 2 other boards where Mercer, Morgan Stanley. You sit on one where Mercer is also the investment consultant, where Morgan Stanley is investment consultant. And what I've done is given them our asset allocation strategy policy and asked them what their expectations are with that asset allocation based on their models, because their model may be different. Their assumptions may be different. The model may be different than what ACG has. And then we have a range of 3. And we then pressure test is our current 7.25% is our current target. Does it continue to be reasonable within this range of 3 inputs that we have? And that's when we'll come down on what we're actually going to adopt. I was just trying to respond to something you brought up. We were not going to make a decision per se today on the
Okay.
discount rate, although I have no reason to question the quality of the work that ACG has done here. And given the quality of work they've done, that 7.25% over the long term continues to be reasonable. And we're just looking for reasonableness rather than preciseness, because you can't be precise over a 30-year period of time. Just want to look at something that's reasonable. So we'll take two other cuts at what is reasonable and see if that 7.25% lies squarely in the middle, or way over at one extreme, or way over at the other extreme. And then we'll decide. Does that sound reasonable? That's what we've done in the past.
Yeah, it's reasonable to me.
There were no action items or recommendations from any of our material today, other than perhaps to say, based on the asset allocation analysis that we're doing, we think your current assumption is reasonable, but it's informational only at this point.
Good, thank you. Is there anything else you'd like to add, Jason and Phineas, in this regard?
Oh yeah, I think that's it.
Very comprehensive work, by the way. That's even more comprehensive than what I have seen from Mercer, although their work also is comprehensive. So I commend you on that.
Thank you. We try.
Good. I'll just make it happen. I mean, this is a analysis and probabilistic analysis. Let's just try to make it happen. And we have to be, and we always have to be on the lookout for significant reasons, compelling reasons, if they do exist, if they do appear, compelling reasons to change our outlook. Is something going on that we had not anticipated? For example, there may be geopolitical reasons why emerging markets as a group, or a large segment of emerging markets, are become uninvestable. And that changes a lot. That changes a lot. So we'll see. We're going on the premise today that all the emerging markets are investable. That may be the case. But we're going to have to stay alert to compelling obstacles, and then adapt adapt our expectations accordingly, and possibly our strategy. Okay. Anything further? All righty. Is there anything else on the agenda we should cover before we go into private, the private session, closed session? Okay, then yeah.
No, I'm sorry. We've been talking to our IT person, and he suggests that we hear visitors before we go into closed session, because there's going to be a problem if we go into closed session and then to come back, we'd have to set up another meeting.
Okay, very good.
So okay, and before we do that, I would like to say something. I think that there's because of the problems that we've had with this platform, there's been some conversation with myself from some retirees, and it's really been put out there that the board is trying to keep retirees out of the meeting. And I just want to say publicly, that's not our intention. And I will work with IT to either go to a different platform or to make this one easier for people to use. I know Mr. Gokin has sent me emails through this meeting saying he cannot get into the meeting. I don't know what to tell him. And I know that there's been issues. There was another issue with a lady that couldn't find the agenda and it was posted. So we will do a better job moving forward, but I just wanted to put it out there that it's not that we're not letting people attend our meetings. So with that, I know
that's a silly concept. That's nonsense. All right, let's.
Okay.
Then we need to, as you suggested, we do need to hear from visitors first. And I don't know how many visitors we have other than Marion. But Marion, I know, wanted to read a statement as part of her comments.
I do. I think I'm still muted though.
No, you're not. I can hear you, Marion.
Okay, all right, on my screen it shows that. Okay, well, I just wanted to share some thoughts with all of you. And so I just figured I would write them out and that would be better. So I'll just read my brief statement. I'm deeply disappointed that you continue to ignore my request from September 30th, 2021, and again, December 30th, for answers to 9 questions about the retirement plan. I've tried to be respectful with my requests, but for 4 months, you've simply ignored my inquiry. The retirement consultant and the actuary and the reports they produce are paid with taxpayer dollars. I believe the information I requested is not confidential and is public information. I don't understand why you as board members aren't willing to be transparent in your actions. Many of you work in the private sector where reports and data are confidential. But in the public sector, nearly all of that information is an open record and public. Lately, communication from you has deteriorated. I noticed that the last set of minutes on the website from the November 30th meeting do not contain any discussion of items, only the agenda and the votes taken. Apparently, none of you even read the minutes, since they state under other business that the county council chairwoman, Rita Days, ordered the item to be received and filed. Obviously, she was not even in attendance, and yet all of you approved those minutes. In the past, the website contained years of minutes, board annual reports, actuary reports, etc. And now all of that communication is gone. Since last fall, the WebEx system used by the retirement board is unfriendly to visitors who wish to speak at the Hear Visitors portion of the meeting. And last month and this month, as Sue just mentioned, the link provided by the county on the website agenda did not even work. And I discovered actually this morning that the agenda that's on the website for the county is a different agenda than the one that was sent to the board, because Sue sent it to me, and there's a county logo on the agenda, and then the link to the meeting is different. The password that shows on there is different. So you're not informing and letting the public get into the meetings last month or today. There's just no way then for visitors who wish to speak to be able to do so. I'm appreciative of the COLA, and although it should be received tomorrow, there's been no communication from the county to explain it to retirees, which surprises me. And I don't understand why it seems like effective communication has ceased. I realize that the world at large right now is often adversarial, which none of us like. For 38 years, I tried to effectively serve St. Louis County taxpayers as an employee. And now as a retiree, I'm trying to look out for retirees' best interests and the county's. But it's difficult to do so without open records and sharing of information. Thank you for your time.
Jerry, are there any other visitors that are on the other side that would like to address the board?
There is nobody in the attendees list.
Okay, thank you.
From a process point of view, I think to go into closed session, we have to have a motion to temporarily adjourn this open session. Another motion to go into closed session. Is that the process, or is it just a motion to go into closed session without the first motion?
Maggie, are you on?
Yeah, I'm on the line, Milt. We need a motion to go into closed session and then a roll call vote about going into closed session.
Okay, we don't need a motion to end this open session first and then another motion to go into closed.
No,
Is that correct?
because you're going to go into closed session, and then after you go out of closed session, you'll go back into the meeting, and then close the meeting.
Okay, very good. All right, may I have a motion to go into closed session? This is a legal matter that the county has brought to our, or the county is aware of and is bringing to our attention.
I'll make a motion to close.
Go into closed session.
Second, Mike.
Okay, moved and seconded, all in favor?
Aye.
Okay, fine. We
Oh,
are,
You need a roll call.
We have to do roll call.
yeah, we also have to make certain that the visitors are no longer participating.
You do a roll
Right,
call
go-
vote first.
Right, once you have your roll call vote to go into closed session, then provided the board agrees to go into closed session, then the visitors would leave the meeting.
Okay,
Okay.
Captain Lore,
Yes.
Bill Wilkins,
Yes.
Mike Bruno,
Yes.
Brian Hansen,
Yes.
Jim Cunane,
Yes.
Emily Koenig.
Yes.
Okay. Can we wait a second and make certain that there are no visitors participating in this closed session? Can you confirm that, Sue?
Yes, we have people from the law department as well as myself and Vicky.
Okay, fine. Marion's signed off and there's no one else.
Right.
What you're saying, right?
Yes.
Okay, fine. I'm going to turn over to our colleagues from the law department to brief everybody on the situation. I'm somewhat familiar with it, having been briefed, a very brief brief, but I'm familiar with what we're talking about. Could you please go ahead?
Good morning, this is Maggie Hartmay, and I apologize, I'm not on video. My video's doesn't work most of the time. As I think most of you have received the letter dated December 15th from Councilman Fitch regarding his claim concerning his suspended retirement benefit since he was elected to the county council. I don't have anything more to report at this time. When we met in December, the county councilor, Beth Orwick, anticipated that there might be more information by this time, and she was going to appear before the board and let you know what was going on. As of today, as far as I know, Councilman Fish has not filed a lawsuit with regard to this claim. Should he file a lawsuit, I believe it's the intention of my office to hire outside counsel because Councilman Fitch is a council member and there could be a conflict with my office in this matter. So I wish I had more to report, well, which I guess could be a good thing. Councilman Fitch hasn't taken any action with regard to his letter at this time, so that's all I know.
These things normally handled by arbitration, mediation, or actual trial litigation.
Well, it would really depend. I mean, there's no requirement to go into arbitration or mediation over something like this. So I can't predict what would happen with it.
Okay, fine. And obviously the county handles this. The pension plan is almost like an innocent bystander. We have an opinion, but we don't really have a vote. So we'll see what the next steps are.
Correct.
Is there anything else you would like to add, Maggie?
Milt, I really just don't have any more information today than I had in
Okay.
December with regard, nothing new has happened with the matter.
All right, very good. Thank you.
So
there anything-
Maggie, do we need to put a closed session next month or only if you have information for the board?
I would suggest only if we have information,
Okay.
if Councilman Fitch files a lawsuit, that's an open matter, you know, it's an open public matter. So whether or not we'd even need to go into closed session, you know, we would see. So,
Okay.
so now if you're finished with your closed session matter, you would take a vote to go out of closed session, then go into your meeting. I know it's cumbersome, then go into the meeting and close.
Meeting and then close again. Alrighty, fine. May I have a motion to exit the closed session and return to open session?
I'll make a motion.
I'll
Have a
second.
second?
Second, Mike.
Okay, all those in favor? I guess we have to have a roll call here.
Yes, you do.
Captain Lore,
Yes.
Bill Wilkins,
Here, yes,
Mike,
sorry.
Mike Bruno,
Yes.
Brian Hansen,
Yes.
Jim Cunane,
Yes.
Emily Koenig.
Yes.
Alrighty, now we're back into open session. Now, Sue, does everyone have a copy of the letter that Marion was referring to?
I think she sent it to the board. I have worked with Maggie to come up with what is public record and what is not. And so I am going to meet with Marion. I reached out to her this week and I'm going to meet with her next week to try to get at some of the issues that she's talking about. I know she got information from the budget director on some of those issues. You know, public, I mean, stuff is posted. You know, we redid the county website, and now we're doing the extranet that will include the retiree page. I don't, you know, some of the stuff she said, I don't know is true, but I will work with her and we will get her answers to her questions if they're public record.
Yeah, Mill,
Yeah.
this is Maggie. You know, I
Yes.
reviewed the list or the questions from Marion, and you know, sometimes what I don't think people understand is there's a difference between saying, you know, I want the governmental entity, whether it's a board or anybody, to go out and produce information, as opposed to I want a copy of a record that you already have. So some of the things that Marion is talking about is, you know, gee, I want to, you know, I want you guys to let me know, you know, information. And that's really a decision of the board as to whether or not, you know, provided, you know, there's no record of this already, whether the board wants to go out and go through the work, you know, whether they have to deal with the actuary or go to ACG or whoever to say, okay, well, now we want you guys now to compile these reports because somebody's asked for these reports to be prepared. And that can involve cost, you know, extra costs and those kinds of things. So, you know, that's really then a board decision. But I agree with Sue to the extent that these records aren't already there. I disagree with Marion's characterization that the board, you know, is not being transparent and hiding things from the public because, you know, the county gets requests from people all the time. Well, gee, I want you to produce this information for me. Well, that's not what the open records law is about. The open records law is you've got a record, I want a copy of it. So, you know, I think Marion's confusing those things on a certain level.
And some of the questions are of such a detailed nature that reasonably a retiree can't do anything with the information whatsoever. I mean, it's not what a normal retiree would think about and want. So that brings up the question, why is it being requested?
Well, and
as
honestly,
we release information, we don't want it to be misused, taken out of context, etc.
I agree with that, but under the open records law, nobody has to give the governmental entity a reason why they want it. You know, they can just say to the governmental entity, if you have this record, I want a copy of it. Now they're supposed to pay for the copy, but it's a minimal amount of money, like 10 cents a page. So, you know, it could be for no reason, or it could be for any reason. It could be for a stupid reason. It doesn't make any difference if the governmental entity's got the record and somebody asks for it, and it doesn't matter who it is, doesn't matter why they want it, you know, the government entity is supposed to turn it over. Like I said, with a number of Marion's requests, I don't, you know, it's not information that I've seen the board have. You know, it's possible, you know, the actuary has, I can't remember one of the examples, Sue, I don't have them in front of me, you know.
Average age of the police and civilian retiree.
Right, like the average age. You know, I don't know that we have a record on that. Now, it's not to say that you couldn't go to the actuary and say, actuary, would you produce this information for this individual, and then create a record, you know, to give to her. But the actuary may say, well, that's fine, but that's going to involve additional cost. And, you know, then the board has to decide whether or not it wants to incur that additional cost to then create that record for that individual. So some of the stuff, like that's an example, you know, I don't think the county has that record. And so then the response is, we don't have that record, Marion. And then it's up to the board about, you know, then Marion can go to the board and say, well, I want you to create that record, you know, and the board can either say yes or no, you know, we don't want to create that record.
Well, and I think that's what Marion should do. If there's records that we can't produce, she should come back and tell us why she wants it produced to make it rational for us to do it.
Right. And so, yeah, some of that stuff is, you know, gee, you know, I want the board to start producing these records, or I want you to create, you know, then the board can say, well, we either want to do that or we don't want to do that. You know, and some of these, you know, that's up to the board's discretion.
Yep.
Right.
Well, and I would think her comments about like the agenda, the reason why the address is different is because there's one address for the board and there's a different address for guests, right? I mean, so I mean, she made a lot of statements about the fact that the agenda was altered and was not the same that's posted, but I think the details that she was talking about, a logo and
Right.
the links are related to the fact of the, you know, what status do you have entering the meeting?
Right.
Well, and I'll just say, I mean, I took the comment to home. I did read the minutes to the last meeting. I was not at the last meeting. I think I seconded the motion to approve the minutes. That was kind of more in just expediency. I know Mike had said, you know, would you want to be first or second? And so I was kind of just, so I apologize for that. And if you want to find a different second and have me abstain from approving the previous minutes because I wasn't present, that's okay with me. I'm sorry for moving so quickly.
Well, Brian, Maggie, the email that you sent to me, or actually Sue forwarded to me the email response that you sent to her regarding Marion's questions. Sue or Maggie, would you send that to the entire board as well, just so they have the background to give a little bit more detail to your comments?
I'll work with Sue on that. Sue's better at sending things out to the entire board than I do. She's got the group link.
Some of the stuff is an actuarial report. Some of the stuff is in the annual report, but nevertheless.
Okay.
Okay. Sue, I need to talk to you and Denise after this meeting is over. But other than that, is there any other business we need to discuss? New business. Okay, may I have a motion to adjourn the meeting?
So moved.
May I have a second?
Second, Mike.
All those in favor of adjournment, please say aye.
Aye.
Aye. Anyone opposed? Okay, this meeting is adjourned. And again, I just need to talk to Sue and Denise about an administrative item. You can stay on if you want to, or click out.
Thanks, guys. See y'all.
Thank
Thank
you
you.
all. Bye.
I wanted to clarify something about the annual report.
Mm-hmm.
I sent over all the material for the annual report back in August or September. But Denise, you seem to indicate the annual report had not yet been published. Were we talking about different things?
I didn't think I had received an updated letter from you, but I can go
Yes.
back in my email and check.
Well, I sent it to, I thought you, but certainly Sue and Maggie, and as well as you, as I think, as well as all my comments in the body of the of the of the report, because there were certain things that needed to be updated. But I sent all that stuff back in August and September, because I wanted to get it out early, but it isn't out yet. That's what I understand. I wish you
That's correct.
wish you had told me, because we've had some miscommunication if that's the case. I will, Denise, I will look in my